How to pay your mortgage faster. Prepaying your mortgage can save you thousands of dollars in interest. There are several ways you may go about shortening the life of your mortgage. For example, you might contribute extra money each month or year. Alternately, you might be able to refinance your mortgage and take advantage of lower interest rates. Whichever method you choose, the key is to make consistent payments. Method 1: Making extra payments. 1. Check if you can make extra payments. The key to paying off a mortgage early is to contribute extra to the principal balance. The lower your principal, the less interest you'll have to pay. Accordingly, check with your lender whether you can make extra payments. Some lenders will let you make extra payments but only at specified times. Lenders may also charge prepayment penalties. Call up your lender and ask what happens to extra payments. Make sure they go to the principal because some lenders hold on to the extra payments and apply them to interest. 2. Pay your mortgage every 2 weeks. You can make an extra month's payment each year by paying half of your monthly mortgage payment every 2 weeks. If you have a 30-year mortgage for $220,000 at 4% interest, then you'll pay off your mortgage 11 years early. For example, your monthly mortgage payment might be $600. Pay $300 every 2 weeks on the 1st and the 15th of every month. To make things easier, automate your bill paying. Alternately, you could divide your monthly mortgage payment by 12 and contribute the amount to each month's payment. For example, your monthly payment might be $600. You can contribute an extra $50 and pay $650 each month. In this way, you'll make an extra month's payment each year. 3. Make an extra contribution each year. You might not make enough money to pay extra every month. However, if you come into a lump sum of money during the year, you should direct it toward your mortgage payments. For example, you might get a bonus or raise at work. You should also use any tax refund to pay down the principal on your mortgage. If you inherit money from a relative, you can also contribute that windfall to your mortgage principal. 4. Round up your payments. If your mortgage payment is $712, then round up to $750 or $800. Every little bit helps. Choose an amount you can afford and budget for that amount. 5. Start early. The sooner your early mortgage payoff efforts begin, the more money you will save. During the first 5 to 7 years, the bulk of your payments go toward interest. Any extra amount goes directly toward the principal amount of your loan. Accordingly, pay more in the early years when your monthly installments are primarily interest payments. However, it's never too late to start paying off your mortgage early by sending in extra money each month or year. To check how much you will save, use an online calculator. The AARP website has a calculator that is easy to use. Method 2: Refinancing your mortgage. 1. Refinance for a lower interest rate. With a mortgage refinance, called a refi, you get a loan that pays off your current mortgage. Ideally, the new loan has a lower interest rate, which means your monthly payments will be lower. There are many lenders willing to refinance your mortgage. You can start with your current mortgage lender and then check rates at any other bank where you do business. You can also search online for interest rates. Generally, your refi should lower your monthly interest rate by at least 1 percentage point, otherwise it probably isn't worthwhile. 2. Refinance into a shorter term. You can also pay off your mortgage faster if you refinance a 30-year mortgage into something shorter, e.g., a 15 or 20-year mortgage. This type of refinance will reduce the total amount of interest that you pay. Your monthly payments might not be lower. For example, refinancing a 30-year mortgage at 4.5% with a 15-year mortgage at 3.5% will save you money in the long term. However, your monthly payment will be larger. Confirm that you can afford the monthly payment. Nevertheless, you can certainly pay off a mortgage faster by refinancing with a shorter-term loan. Use an online calculator to determine how much you will save by refinancing. For example, Zillow has an online calculator that is easy to use. 3. Gather required documents. You'll need to show your lender financial information, so collect this ahead of time. Doing so will make the application process smoother. Proof of income, such as 2 recent pay stubs or a profit and loss statement if self-employed. current tax returns. Tax forms, such as your W-2 or 1099s. Proof of homeowner's insurance. Title insurance. Recent credit report. Information on your monthly debt load. Documentation on all assets, such as stocks, bonds, real estate, savings accounts, and retirement accounts. An appraisal. 4. Don't borrow too much. Lenders may pressure you to take out more than you need. For example, your home might be worth $140,000. However, the mortgage could be only $65,000. Some lenders will encourage you to take out the max, which is usually 90–95% of your home's value for a conventional loan. In this example, you could borrow $126,000, which is much more than you need. Going deeper into debt doesn't benefit you. Yes, you might pay off your mortgage faster, but now you have a new debt. 5. Review the terms of the loan. Make sure there aren't hidden fees that will increase the cost of the refinance. For example, pay attention to the closing costs, which can substantially add to the amount you borrow. Some lenders might claim they won't charge you for closing costs. However, the costs are really rolled into the loan. Read the fine print. 6. Contribute your extra savings to the principal. A mortgage refinance will benefit you the most if you use the money saved to pay down principal. For example, your monthly mortgage payment might have dropped from $1,000 a month to $650. Contribute that extra $350 to the principal on your loan. 7. Remove your private mortgage insurance, PMI. You'll pay this insurance if you financed more than 80% of your conventional mortgage. PMI costs roughly 0.051% of the loan amount, a meaningful sum. You should cancel this insurance and direct the amount to your principal. You can ask to remove the PMI once your loan-to-value ratio reaches 80%. And your lender is required to remove it once you reach a 78% ratio.